Most new investors don't lose money because investing's too hard. It's just that they fall into totally avoidable traps. If you're just starting out, this video could honestly save you years of headaches and maybe even thousands of bucks. Stick with me, because by the end, you won't just know what to do. You'll get why it works and how to actually keep at it. Think of investing like planting a tree. You don't plant it today and expect fruit tomorrow. You've got to nurture it, protect it from storms, and just give it time. That's exactly how building wealth works. And here's the good news. You don't need to be some financial genius. You just need the right foundation. So let's break it down into 5 key things every beginner should know. Here they are. Think long-term, understand risk, keep it simple, invest regularly, and always keep learning. First up, think long-term. Winning at investing isn't about guessing what the market'll do next week. It's about what happens over the next 5, 10, even 20 years. In the short run, it's a roller coaster. Ups, downs, crashes, recoveries, but over time, it usually goes up. Picture 2 friends. Alex tries to time the market, always jumping in and out, second-guessing everything. Jordan just invests steadily for 20 years, no matter what's going on. Almost every time, Jordan comes out ahead, even if Alex gets lucky once or twice. So if you're new, don't stress about finding the perfect time to buy. The real win? Staying invested long enough for compound growth to do its thing. Time is what really drives your returns. Next up, understand risk before you chase rewards. New investors get pulled in by hype, crypto spikes, hot tech stocks, whatever's trending online. And yeah, some folks make quick money, but most lose it just as fast. Here's what really matters: your risk tolerance. Think of risk like a roller coaster. Some people love the wild drops and loops. Others would rather chill on the Ferris wheel. Neither one's wrong, but you've got to know which ride you can actually stay on without freaking out halfway through. Because here's the truth. The second you panic sell during a downturn, you lock in your losses. Smart investors match their portfolio to what they can actually handle, not just what looks exciting in the moment. Honestly, sleeping well matters more than chasing headlines. Quick pause. Don't click away. What I'm about to share is the insight that separates dabblers from real wealth builders. Here's the deal. If you leave now, you'll miss the one strategy that consistently beats most beginners who try to outsmart the market. Stick with me for the next minute. I promise it'll be worth it. Third insight. Start with a simple strategy. Here's a secret nobody tells beginners. Simple strategies usually beat the complicated ones. Instead of trying to pick the next Tesla or Amazon, you can just buy index funds or ETFs, basically baskets of hundreds of companies at once. The S&P 500, for example, has usually returned about 8 to 10% a year, on average. So if you put in $1,000 and just left it alone, in 30 years, it could grow to over $10,000. It's like betting on the whole league, not just one player. Sure, some companies will flop, but others will soar. An index fund balances it all out. And here's the kicker. Most pro stock pickers, even hedge funds, don't beat the market over the long haul. So if they can't, why should beginners even try? Fourth insight. Invest consistently, not perfectly. Another big mistake? Waiting for the perfect moment to buy. Truth is, nobody knows when that is. That's where dollar cost averaging comes in. It's just a fancy way of saying you put in the same amount, like $100, every month, no matter what the market's doing. Here's why it works. When prices are high, your $100 buys fewer shares. When prices are low, you get more shares for the same money. Over time, it all balances out, and you end up with a smoother average price than if you tried to time the market. Think of it like this. You go to the grocery store every week, right? Sometimes apples are $1.50, sometimes $1, sometimes $2. It's always changing. But if you just buy apples every week, your cost averages out over time. You don't wait for the perfect price, because honestly, if you did, you'd probably never eat any apples. So yeah, being consistent beats trying to time things perfectly. Alright, insight number 5. Learning beats acting on impulse. Seriously, one of the best things you can do as a new investor is just keep learning. Read some books, follow people who actually know their stuff, and don't be afraid to question the hype. Ask yourself, do I really get what this investment is about? If you can't explain it in plain language, maybe don't put your money into it just yet. Because honestly, confusion can get expensive. Think of investing as a skill. The more you learn, the better your choices get. And in this game, a bunch of small, smart moves can add up to some pretty big results. So, consistency plus learning? That's how you build momentum. It's not flashy, but hey, it really works. Alright, let's do a quick recap of what we've talked about. Think long-term. Match your risk to what feels right. Keep things simple. Be consistent. And always keep learning. If you put even one of these ideas into action, you'll be ahead of most beginners who never bother to learn the basics. Here's something you can do. Pick just one of these insights and try it out this week. Don't wait for the perfect time, and don't make it complicated. Just get started. Small steps are way better than no steps at all. And if you want to go deeper, check out my video on stock market versus real estate. It'll help you figure out which path might fit your goals best. I'll link it right here so you can keep leveling up your investing know-how. Thanks for hanging out with me. Just remember, smart investing isn't about quick wins. It's about building a solid foundation for your future. Start today. Check out the next video to keep learning, and good luck on your investing journey.